What's going on, guys? Welcome back to another episode of the Landlord Society podcast. I'm Charlie. You're here with HDK, and we help Australians replace their income through the Landlord Academy. Today, we're going to be talking about tax and structuring when optimizing your property portfolio, how this helps your strategy.
Let's go.
Let's get into it.
It's a big topic, this one.
Yeah,
it's a big topic.
It's a bit how you going.
We'll try to you'll try to have as much information as possible within this podcast episode. So
without it being advice.
Yeah, without
obviously.
it being advice, of course. That's really important. Guys, I keep stressing this over and over again. Your goal is not to be a tradesman, or a real estate agent, or a conveyancer, or a lawyer, or in this case, a tax lawyer or an accountant. The whole point is we're here to become a good property investor. Yeah, that's what we're here to do.
Yeah, and you're talking about all those things contextually to property investing, because people get so caught up in renovations to the point where they feel like they have to be the tradesman.
Yeah,
and they feel like they have to be their own lawyer. It's bro.
Yeah.
That's not the goal. That's called you're pushing a wheelbarrow around.
Yeah, that's right.
You want to be working. You want the money to work for you.
And there's no scalability with that. So we're investors and we pull levers. That's what we do. Yeah. And the levers will then set a course for the ship to head. Too much analogy. Let's go, guys. People get it. People are afraid of tax. They are afraid of tax. They look at something like tax, especially in a jurisdiction like Australia. They go, it's very, very complex. We have one of the worst, one of the most complex tax systems in the world right here in Australia. Yeah. So no wonder they think that it's a lot to handle. That's why, first and foremost, I suggest that finding an accountant that actually knows what they're doing is really, really important. And I'm not talking about accountants, who can do the tax returns for you, Who cares about those guys?
What specifically would you look for in an accountant?
What I would look for in an accountant is their experience in helping other clients build a portfolio
in property. Yes.
Exactly right. Awesome. But that's assuming that you come to this podcast wanting to build a portfolio. That's the thing. If you just want a property, at the end of the day, if you are communicating your desires, your goals in life to your accountant, and they are able to understand it and able to manifest it, right, in a way that explains to you that it's going to logically work, because it's not sorcery, it's just numbers, right? They need to help you understand what and how it's going to unfold. So,
because otherwise the amount of money you're leaving on the table is
a lot,
astronomical. I feel like the traditional buying a house, like the mum and dad strategy of buy a property, hope it goes up in value, that leaves you're buying your property with after tax dollars, and you're paying, and then of that, the mortgage payment is mostly going towards interest.
Yeah.
And then a very little portion of that is going towards equity. And that's not how to build wealth.
Yeah, exactly right. So look, ultimately, if you are communicating to somebody that, that ABC is what you want, they got to actually let ABC happen. That's the thing. So if you're here to buy a house and just have a nice life, sure, whatever. But if you're here to build a portfolio, then tax questions become a little bit more important, I would say. So basically, being able to talk to your accountant and say, hey, look, this is what I'm trying to achieve. This is a lifestyle that I want. Just being really vulnerable and open and honest with that. And to be able to say, that's what I want to do. Have you had experience doing this? And, come on, you're here on this podcast. You know that the lifestyle that you want comes from properties, right? Buying multiples of properties. Well, in which case, you got to talk to an accountant that has had that experience and understand that that's possible to unfold. So then that's when you're going to have to start exploring, structures that go beyond that of just your own personal name, right? When you start thinking about building portfolios, gone are the days that you'll have a chat with your missus and, go halvesies on the name, on an individual basis. Because there are a lot of concessions that are available in different structuring based around your circumstances. So what are the different types of structuring that's available to you? Because I always use this analogy. I tell people, guys, you cannot get advice on things that you don't ask for. Does that make sense? Yeah. Right? Let's say in your heart, you want a car, right? And you want a ute. Let's say you go to the ute dealership and you ask for utes. They're only going to show you utes, man. They're not going to say, hey, would you like to have a look at a van or a sedan? They're not going to do that because you haven't asked for it. You got to say, oh, how about these? So as investors, what we need to know is a general gist and the sort of the outlook of what different structures are available, and see if that would have an impact over your portfolio, and have an intellectual discussion with your accountant over that.
Right. But how do I actually handle, I want to know how to save tax through property. Tell me.
Yeah, exactly right.
You know, give me the answers.
Okay, great. So first of all, we need to know what kind of structures there are available that go beyond just your name. Okay, so there is trusts. Okay, there's trusts. There is discretionary, which is also referred to as a family trust. Okay, that's a type of trust.
Yep.
There's also a unit trust, which is another type of trust. There are companies as well. Let's just start there for now.
Let's just keep it simple. Let's
keep
just
it
start
simple.
with like a company.
You
entity.
do have your SMSF as well, which is short for self-managed super funds,
Yep.
which come in a very, very interesting shape. And to be honest, in the realm of property, that applies to such a very, very minority of people, which I will get into detail a little bit later, because this podcast is not talking about SMSF. And to be honest, if you are somebody that requires SMSF to invest in property, then I'd say there's probably more issues to deal with that you as an investor, as a financial being,
because you haven't developed the habits that have led you to build
to
the
actually
deposit and et
yeah,
cetera.
exactly right.
However,
Have an
there
income.
are still like the first home super saver scheme where you can buy like use 5% down.
What, on a super?
Yeah, and
Oh.
use the super. It uses your super to purchase as a deposit for the property.
Oh, okay, all right.
Yeah.
Well, yeah, there are those schemes there available as well, which I think is that can set you up forward as well if you can find a good enough. But at the end of the day, these schemes are only beneficial if you find the right property to buy.
Yeah,
Right, the
exactly.
strategies
Yeah,
are
yeah.
incredibly important.
Yeah.
So swinging back to the companies and then the trust, right? So I'll talk to you about each element. So if you have a company, you've got your directors and your shareholders, right? Directors have to be a natural person. Okay. And they decide on what happens within a company. And the company could be the thing that owns your property, right? So you set yourself up as a director, or, you know, ideally it'll be yourself, right? And then with the shareholders, it could be anybody. And the shareholders have fractional ownership of whatever the income is on the property, whether that's by way of capital or by way of income. So you could set up a shareholder, let's say 100% shareholder as myself. You can set up another company as a shareholder, and you could set up a trust as a shareholder as well. Right? That's where the asset gets distributed down to. This would be especially helpful if you wanted to have a structure where you are investing in property together with other people as well. And yes, you can have more than one directors too. So based on this, there are certain circumstances where having a company would be beneficial. Okay.
Whoa, hold up, Landlord Society. Are you sick and tired of the rat race and you want to start building wealth with property and generate passive income?
Then come and drop us a follow on Instagram and DM us the word Landlord.
The word what, Charlie?
The word Landlord, like the Landlord Society.
Okay, wait, Charles, what's our Instagram handle again?
At landlord.society.
You heard him, everybody. DM us the word landlord to our Instagram to learn more about property investing. Now back to the podcast.
Let's swing around to trusts. Okay, trusts are very similar to companies, and we're going to talk more so around family trust, discretionary trust. Okay, family and discretionary trust are the same things. These trusts have what's called a trustee, which can be a natural person or yet another company entity. So, and that company will not be doing any trading activity. All they do is simply make decisions on the company, on the trust, as in the role as a trustee for the trust. Okay, you've got your beneficiaries, which in the form of family and discretionary trust will be what we call potential beneficiary, centered around what's called a primary beneficiary. Okay, so there's a named primary beneficiary, and we will probably say their relatives and their family, they're interested, companies that they have interest in, or entities or charitable organizations or whatever. And basically the trustee can decide the assets or the income of the property to be distributed to whoever they want it to be at their full discretion, on as soon as there's income that comes into the trust itself. So that could be beneficial for people who have a big family and you have children above the age of 18, or you got elderly parents that have stopped working, and no, it does not always benefit them, because if they're on pensions and things like that, then obviously that would impact their income, and that might preclude them from certain pensions and whatever. And so it gets quite complex, and your situation is incredibly important around that. You could also have a unit trust, which kind of behaves like a company, where unit holders have different percentages of ownership. So you can set up 3 units, and each unit holder has a unit each. Then each unit holder would effectively get 33% share of the dollars that come through the actual entity itself. And what generates those dollars? Well, it's property.
Right.
And also, depending on the types of property, whether it's going to go up by capital, whether it's going to generate a lot of passive income for you, then putting it under these structures would be incredibly helpful. Whether you would be somebody that requires a restructure, therefore, would also hinge upon the liabilities that you might have into paying stamp duty. So if I go, I own the property myself, I want to put it under a company, that is actually a transfer. If you trigger a transfer, you will pay your duties, right? Your stamp duties, right? So all those things will have an implication into it. And who runs all the numbers there for you? Accountants. Yeah. Tax lawyers.
So Handel, if someone comes to you and says, when would it be a good idea to buy properties through a entity, like a corporate entity? What would you typically respond? How would we respond to that?
Yeah. So look, that's a really, really good question, but unfortunately it's misdirected. Okay. So it's misdirected first to the wrong person, which is me, right?
Yeah. We're not here to tell you how to structure things. We're not tax professionals.
Exactly right. But second of all, it's misdirected in that the first question you should be asking is, what do you plan to achieve in your life? Right? What's your ideal lifestyle goal? And that goes down to how many children do you want to have? Like, are your grandparents alive? Are your parents alive? Do you have any cousins or families? Are some of them absolute duds, like that make no money? Like all sorts of these things. Do you want to make charitable donations on a yearly basis? Do you want to, how many properties do you want to own? How many dollars do you want to earn passively? Do you have an existing business where there's write-offs within the business? How much income do you generate through those businesses? How many employees do you have within those businesses? Do you have any depreciating assets within those businesses, like vehicles or even buildings and properties? Do you have a rental property right now, where you're generating income, and are you actually renting right now as a place of residence? Like what and how do those plans? Do you plan to have more children? Right? Or are you done here? Like it all has an implication into this. Do you expect inheritance even?
Yeah, exactly.
So
these things will shape the direction of where you go.
Exactly right. And there could be more based on the answers that you generate out of it. There could be more that needs to come out of it. That's why there is what's called a fiduciary duty between accountants and clients and lawyers and clients, where all of their information is held in safe space, if that's a good way to put it.
Yeah.
So you start there, and based on that, you will go, before you buy properties, the best time to receive advice is today, actually. Yeah. Today is the best time to receive advice.
Even if you think you're not ready to take action, it's a good idea to get that advice.
Hey, this is what I'm planning to do, right? Would this be a possibility? And a good accountant will know the implication and the manifestation of all the decisions that they're making for you, and they would actually care about it. Right. And these are the accountants that have walked the walk before, so they will have those experiences. So if you are not working with an accountant where they're ideally living sort of that, that ideal lifestyle that you have, then there's really no point receiving advice from somebody who's never done it before. Yeah. It's a waste of time. And, I've heard this before. Oh, so-and-so, my cousin's uncle's dog's father's, sister is an accountant. I'm just like, come on, mate. Like, that does not justify that you work with them. Yeah. And you know what? If you love your family, don't give them a job. Just optimize your wealth with somebody that actually knows how to do it. And with the money that you make, you just give them money. You know what I mean? That'll be the best gift for them. You know what I mean? So at the end of the day, it comes down to whether these professionals in your corners are going to be able to help you throw the punches in life the best way possible. Yeah. Right. So that's what they will do. And then what will happen is, okay, you want to put it under a company? Yeah, great. There's also implications of these decisions onto finance as well. Right. I'll give you a simple example. If you say earn about, I don't know, $80,000 a year, and you've got no other dependents, you're all on your own or whatever, and you see a finance broker, and the finance broker happens to tell you, or I'm not saying this will be your serviceability, whatever, no rule of thumb business here, says, oh, you can borrow up to $500,000, okay? And your budget, they say, ideally keep your budget on a property around $500,000. You've got $100,000 as a 20% down payment on an 80-20 LVR, okay? Great. If you don't understand these meanings, well, follow us. Yeah. then you'll be able to understand what these mean. Then they will go, okay, yeah, fair enough, all good. They will go and search for a property. Let's say they bought a property, right? Serviceability is the ability to pay off the loan. They get that property. The property positively geared, right? Makes more money. Means you can meet those liability all good, right? So technically, you've borrowed the money, but you got no issues paying it back. Does that make sense? And your cash flow hasn't been affected. Well, it's been affected. You make more money now, actually. But you have borrowed that $400,000 out of about $500,000 borrowing capacity battery, if you'd like. Yeah. Right? And then you go, oh, and then I want to buy another property. right? I want to buy another property. Okay. You go knock on the bank and say, oh, I've done this and it's done really well. It's grown in value, this and that, whatever. It's brought me equity where I've made another $100K to buy another $500,000 property. And the bank looks at you and go, well, hang on, you've already got a $500,000 loan. You've depleted your battery. Like you depleted your service.
No more serviceability.
We can't lend you anymore.
Yep.
But there are certain banks out there, okay? And you will need a very crafty finance broker to be able to find something like
creative
this.
one.
Creative one, a good one, right?
Yeah.
That's from my experience, is that when you actually are in a situation like this, and if you're structured individually, I'm pretty sure the jury's out. You got no more.
You can't do anything else.
Anymore.
You're cornered. Yeah.
Pretty much, I know. But if you are structured differently based on different structures, there are banks who would look at that on an isolated basis.
Yeah. So they look at the entity, right?
Yeah.
They say, well, this is a profitably trading entity.
Exactly.
Let's see how much we can borrow through this.
Yeah, and then you go, oh, but and then I make this much money, and they go, oh, okay, that's all good.
Yeah.
It really depends on those things. So if that's why finance and accounting, look, people go, oh, I need a good accountant. I need to structure myself from a tax point of view to save taxes. You're doing a lot more than saving taxes, actually. If you structure yourself properly, then you can actually open yourself up to more finance options, which if you're getting more finance, it's for the purpose of obviously making more money through properties.
Yeah.
In which case you can then actually generate more income that way. Does that make sense? So you would want to save. I understand that, but there could be more income that comes through proper way of structuring. That's the thing. Yeah. And, and another thing that I would like to, make people aware is that, with complex structures come with, bigger professional fees as well, obviously. So that has to be all priced in and has to actually have feasibility before you go around willy-nilly trying to put properties under companies and whatnot. But having that relationship built with an accountant that takes you throughout your life, establish your wealth in a constructive way based on experience would be the most optimized way to move on your tax structuring.
Yeah, absolutely right, HD. I think that for people moving forward, taking the next step in their property journey, some of them are optimizing for tax specifically without really knowing what they're doing. I think it's like an absolute crucial part of this whole process to have a professional in your corner to make sure that you are optimizing where you need to with the strategy that you have in mind. So that's what's going to set you up for your future. And if you do need help with that, guys, send us a DM and we can point you in the right direction. Cheers. Been awesome.
Peace.
Peace.